up 2.1% year over year. That is worse than expected. Up 0.5% month over month. That is why we are seeing this market move quicker and fast than we expected. The market is giving up a lot of the gain because this number is much higher than expected. There you have it, 2.1% on the CPI. Mitch, Roschelle, market just turned negative.
So the December number was also 2.1. The estimate was 1.9. So it's not red hot. It's a little higher than expectations, but it's not red hot. And we'll see how the market responds. Obviously, it's swung to the downside.
Not good with the retail sales number. Inflation's up. Sales are down. Retail sales down 0.3%, Mike Murphy. We wanted to see a good retail number after the tax plan. It's not what we're getting right now.
Yep. So I think this is kind of the worst case scenario for the market coming out now. Again, this is an immediate reaction, but you have this inflation number that's coming in, although it only looks like it's 0.3% higher. That's a big difference in the number that was expected to what we're seeing. So the market's not going to like this. We've had a 300-point swing in the futures, and I think this is kind of this is bad news for the market, I think.
Major market move here, down 113 points, Dagan. We were waiting on a number. Core inflation year over year, 1.8%. That's the CPI year over year is 2.1%. Core is 1.8. Any way you look at this, this is hotter than we expected.
Yeah, the core was expected to come in a little bit lower than that, 0.1% lower. Again, the biggest fear in these markets and what triggered it was that wage gain number that we got in early February about an economy that we want an economy that's growing faster. We want an economy that's warmer than it has been over the last decade. However, it's not so much inflation today that's the worry. It's the overreaction to that inflation.
Mm-hmm.
Will the Federal Reserve get more aggressive in terms of fighting that inflation down the road?
This retail sales number is the largest decline on retail sales in 11 months, Mike.
So there'll be more. It's important to read through that number because I want to see exactly what makes up that number. But I think it's important, Maria, for the people at home watching, this is a headline-moving number, so you see the market react in a big way to it. But we've rallied for the last 3 days. If you're sitting at home with your portfolio, this doesn't mean go on E-Trade or start liquidating your holdings. I would say sit tight. If you have a long-term plan, this isn't something you want to sell into.
They're selling into it now. 219 points lower on the Dow Jones Industrial Average Futures taken.
It is worth looking at like a TIPS ETF. These are Treasury inflation-protected securities, a portfolio of bonds that are protected if inflation starts picking up. Those securities actually, during that massive sell-off last week, didn't do that well.
Right.
You didn't see a major rally in them. So that's something that if you're trying to add some ballast to your portfolio and you're worried about, even fixed income losses, like losses on treasuries as yields go up, that's something to start thinking about.
This market is falling out of bed, guys. We're down 300 points right now as this market digests a higher inflation number and a lower retail sales number, Mitch.
The one thing about retail sales to really focus on, this is probably why the market's reacting the way it is how key to GDP growth the consumer is, and the consumers are the retail sales numbers. So that's what's moving that. Maybe we're not going to see the GDP growth that we expect. If there's a silver lining in any of it, the thing, and Dagan talked about it an hour ago, I do worry about household debt. So if we're seeing a slowdown in retail sales, that may mean we're not inflating the balance sheets of consumers.
I think this reaction in the market that we're seeing 400-point swing right now I don't think that has to do as much with retail sales as it has to do with what's been what's been spooking the market is inflation.
It's up 0.5.
Inflation picking up. That's why you're seeing program trading going off, selling this news, dropping the market in a big way.
So inflation is an issue, and that's going to be what the Fed focuses on.
You would know that the inflation was an issue even before this number came out. But we've been talking about it on this show, but you've had CEO after CEO of major corporations talking about rising costs, metals, foodstuffs. I said this earlier, the world's Cisco, the big food service distributor, overall food inflation of more than 3% in its most recent quarter. Ford grappling with higher material costs, Caterpillar, Whirlpool. It's starting to work through the supply chain, these higher costs.
And not just material costs, but also labor costs. Which
right, so that's the double whammy.
It is a double whammy.
What do you do here in a market that's down 300 points, Mike Murphy? You're invested in this market. You're bullish on stocks. We've got a market that's fallen out of bed on an inflation scare right now.
Yes, but I think what you do, Maria, is you take a deep breath and you sit back. This morning is not the time. If you've been holding core holdings in Amazon and Microsoft, and Facebook and Apple for the last year, 2 years, 3 years, you don't get up this morning and say, sell, you're going to sell that. Let's see how the market reacts to this. I don't believe this is cause. We had an 11% drawdown peak to trough in the market. I don't think this is a cause for a bear market. I don't think this is cause for some sort of major market collapse. This is a several 100-point move, which has become normal. We were down a few 100 points yesterday. We closed flat. We've had 3 up days. The market is going to open down today. The market goes up and it goes down. Take a deep breath. Look at the information. If you're too exposed to equities, sell them on this sell-off. Sell them on any rally.
But here's the danger that we do need to point out to people. If you are trying to reallocate your portfolio and reduce your stock allocation, you have to be careful what type of fixed income that you put it in, because if you have longer-term treasuries and you think that those longer-term rates are going to keep going up north of 3%, that's a loss. That is a principal loss in that investment if you're not careful.
That's the asset allocation challenge, because we're entering a period of rising interest rates, and if you go from equities to fixed income and bond prices go down, unlike the way the New York Times reported it,
they don't know that when yields go up that the price of a bond falls.
You mentioned the PPI earlier.
Yeah.
This is the producer price index out Thursday.
Yeah.
This is telling us that the higher increases have gotten to the cash register. When you go to check out in the supermarket, this is the consumer price index. That's impacting you. Yeah. That's why this market has fallen out of bed right now.
Yeah, although I'm still going to wave the caution flag, because, again, the numbers for January are really exactly the same as they were for December. So we're not seeing inflation rising. We're just ahead of where we were from an expectations perspective.
Just really quick, I want to point out something about because I keep bringing up the unprecedented stimulus and monetary policy we saw from the Federal Reserve over the last decade and from other central banks around the globe. The central problem is that this sea of money, this cheap and easy money that was pushed into the economies, it never benefited the average folks in this country. They didn't see wage increases. Instead, it was asset inflation.
Stock market,
junk bonds, real estate,
Puerto Rico
stock
bonds.
market. So the average person in this country could still be okay if we have an economy that's on stable footing and have higher wage increases, even if, as long as people are careful, even if you have and these asset bubbles.
Yeah.
Yes.
John Hill's in here. Go ahead. No.
I was going to say, because interest rates are rising does not necessarily mean the stock market goes down. The stock market can move up in a rising interest rate environment.
Well, let's put this in context. We are only talking about 2.88% on the 10-year. I recognize it's a different. Let's show the 10-year rate. I recognize this is a different direction than what we've seen, but we got rates moving up, and that's the negative. But 2.8%. Who's afraid of 2.8%?
Do you know that when Paul Volcker was fighting inflation in the 80s, the 10-year yield was at 15%.
Right.
I think.
There you go. That's what I'm trying to say.
I got my first mortgage too. So
yeah, but
you paid 15%.
I paid. Well, my teaser rate was 13.
Oh, 13.
But you know what? That asset price was a heck of a lot cheaper.
Well, that's a good point.
That's
absolutely right.